VIP John AG here. Silver just ripped 15% off the lows, 15%, from under $29 to trading right around $32.60 as I record this. That is a violent move to the upside after one of the most aggressive sell-offs we have seen in months, and now the internet is split right down the middle. Half the people are screaming the bottom is in, load the truck, and the other half are calling this a textbook dead cat bounce before we plunge to $26. So which one is it? I am going to walk you through every single data point I can get my hands on, from COMEX inventory numbers to Shanghai premiums to what the Federal Reserve just signaled. And by the end of this video, you are going to have a framework to make your own decision with clarity, not emotion. Because right now, emotion is running this market, and emotion is how you lose money. Let me break it all down. Let us start with what actually happened. Silver peaked near $34.50 recently on the back of that massive rally that took us from the low $28 range all the way up. Then we got slammed. And I mean slammed. We dropped over 15% from peak to trough in a matter of sessions. That brought us down to roughly $28.70 on the COMEX spot. Shanghai was trading slightly different, but the damage was real and it was fast. Open interest collapsed. Leveraged longs got liquidated. The COT report showed managed money longs getting flushed out at a pace we had not seen since the crash earlier this year. It was ugly. Now from that 28.70 level we have bounced. As of right now, COMEX spot silver is sitting at approximately $32.50 to 60 cents. That is a recovery of roughly 15% from the bottom. Gold, for context, is trading around $3,320 per ounce, holding up significantly better as it tends to do during volatility events. The gold to silver ratio expanded aggressively during the sell-off, blowing past 100 to 1 briefly, before pulling back to around 102 as silver began to recover. That ratio tells you something. It tells you that silver was hit disproportionately hard relative to gold, which is a signature pattern of paper market liquidation, not organic selling by physical holders. Now let me give you the COMEX numbers because this is where it gets really interesting. Registered silver inventory at the COMEX is sitting at approximately 138 million ounces. That number has been grinding lower for months. Total COMEX silver inventory, registered plus eligible, is hovering around 275 million ounces. Sounds like a lot until you realize that global industrial demand alone consumes over 650 million ounces per year. The Silver Institute's most recent data shows that we are running a structural deficit for the fourth consecutive year. Total global demand came in above 1.2 billion ounces, while mine supply plus recycling delivered roughly 1 billion ounces. That is a gap of over 200 million ounces annually. Let me say that again. 200 million ounces of deficit every single year for 4 years running, and the price dropped 15%. Does that make sense to you? It does not make sense unless you understand that the paper market and the physical market are two completely different animals. Let me talk about Shanghai. The Shanghai Futures Exchange silver contract has been trading at a premium to COMEX consistently. Right now, that premium is roughly 4 to 5% over the equivalent COMEX price when you factor in currency conversion. At one point during the sell-off, the Shanghai premium widened to nearly 7%. That is the physical market screaming that real buyers want metal and are willing to pay above the international benchmark to get it. China imported over 7,000 metric tons of silver in the trailing 12 months. Their solar panel manufacturing alone is consuming record amounts. When you see Shanghai paying a premium while COMEX is dumping paper contracts to push price down, that divergence is a signal. It is not noise. It is a signal that the paper price is detaching from physical reality. On the macro side, the Federal Reserve held rates steady at their most recent meeting. The federal funds rate remains in the 4.25 to 4.50% range. Fed Chair Powell indicated that they are watching inflation data closely and did not commit to rate cuts in the near term, but the dot plot still suggests the possibility of 1 to 2 cuts before the end of this cycle. The market is currently pricing in roughly 60% probability of a cut within the next 2 meetings. Here is why that matters for silver and gold. When rates come down, the opportunity cost of holding non-yielding assets like precious metals decreases. That is bullish. But more importantly, Rate cuts typically signal that the economy is weakening. And when the economy weakens, you want real assets that cannot be printed into oblivion. The US dollar index, the DXY, has pulled back from its recent highs and is trading around 103.5. A weakening dollar is historically supportive for precious metals priced in dollars. Meanwhile, Bitcoin is trading around $107,000, continuing to hold near its all-time highs. I mention Bitcoin not as competition, but as context. Both Bitcoin and gold are making new highs or holding near them, while silver lags dramatically. That divergence will not last forever. Silver either catches up violently to the upside or everything else comes down. Historically, silver catches up. Now here is where I want to drop the call to action because I know a lot of you watching right now are not subscribed. The data shows that roughly 75% of viewers on videos like this are watching without subscribing. If this kind of raw, unfiltered analysis is giving you a clearer picture than what you get from mainstream financial media, do me a favor and hit that subscribe button. That is how we build this community. No algorithms, no tricks, just real data and real talk. Drop VIP John AG in the comments so I know you are part of Team VIP. And if this is not for you, no hard feelings whatsoever. I do not chase empty metrics. I do not sell courses. I do not sell signals. I do not sell mentorships. This channel is about protecting capital and understanding what is really happening. That is it. Now let me get to the smoking gun, because this is the part that should make your ears perk up. During the sell-off, while silver was crashing from $34.50 down to $28.70, COMEX delivery notices told a completely different story than the price action. Let me say that clearly. While price was collapsing, entities were standing for delivery of physical metal at an accelerated pace. We saw delivery notices in the thousands of contracts during the front month. That is not what you see during a genuine bear market. In a genuine bear market, nobody wants the metal. They are selling, they are running, they are liquidating. But here, someone or multiple someones were using the lower prices to pull physical silver out of the COMEX system. Registered inventory dropped by over 3 million ounces during the sell-off window. 3 million ounces walked out the door while the price was crashing. Connect the dots. The paper price was driven down through massive short selling on the futures market, and while retail traders were panicking and getting margin called, large players were scooping up physical metal at a discount. This is not speculation. This is documented in the CME delivery reports that anyone can look up. And here is the smoking gun within the smoking gun. Bank participation reports show that 4 or fewer large commercial banks held a net short position of over 200 million ounces of silver on the COMEX. 200 million ounces. That is more silver than exists in the entire registered category. These are the same banks that have been fined repeatedly for spoofing and manipulation in the precious metals markets. J.P. Morgan paid $920 million in fines for precious metals manipulation. $920 million. That is not a conspiracy theory. That is a Department of Justice settlement. So when someone tells you the silver market is free and fair, you show them that number. You show them that the entities controlling the price on the paper market have literally been convicted of rigging it. And here is what makes this truly insane. Despite those fines, despite those convictions, the concentrated short positions remain. The structure has not changed. The referees caught the players cheating, fined them, and let them keep playing the same game. That is the market you are operating in. And that is why the 15% bounce we just saw needs to be analyzed through this lens, not through a simple technical analysis lens. Now let us talk about physical versus paper, because this contrast right now is as extreme as I have ever seen it. On the paper side, you had futures contracts being dumped by the tens of thousands. Open interest collapsed. Leveraged longs were wiped out. The price on your screen said silver was worth $28.70. But walk into any major dealer or check the online premiums and tell me you could buy silver at $28.70. You could not. American Silver Eagles were selling with premiums of $8 to $12 over spot during the sell-off. That means while the screen said $28.70, actual buyers were paying $37 to $40 per coin for Eagles. Generic rounds and bars had premiums of $3 to $5 over spot. 100-ounce bars, which typically carry the lowest premiums, were commanding $2 to $4 over spot, and many dealers had limited inventory or extended shipping times. The U.S. Mint reported that Silver Eagle sales have been strong this year, running ahead of the previous year's pace. The Perth Mint, the Royal Canadian Mint, and several private mints have reported intermittent delays and backlog issues. Meanwhile, industrial buyers in the solar sector, the electronics sector, and the defense sector do not have the luxury of waiting for lower prices. They need silver now. And they are contracting for physical delivery at prices well above what the futures market quotes. This is the great disconnect. The paper market is a pricing mechanism controlled by a handful of large banks with concentrated short positions. The physical market is where real supply meets real demand, and right now the physical market is tight while the paper market just had a controlled demolition. If you understand that distinction, you understand everything you need to know about why this 15% bounce happened and whether it is real. Now let me address the bearish case head-on because balance matters, and I refuse to be a one-sided hype channel. The bearish case is real and it deserves serious consideration. First, the CME Group has the ability to raise margin requirements at any time. During the sell-off, margins were hiked, which forces leveraged longs to either deposit more capital or liquidate their positions. If silver continues to rally from here, another margin hike could trigger another wave of liquidation. We have seen this playbook before, most notably during the 2011 silver rally to $50 when 5 margin hikes in 9 days killed the rally. Second, if the broader equity market enters a serious correction, silver tends to get sold first. It is a small market with high volatility, and it is the first thing leveraged funds dump to raise cash. The S&P 500 is trading near all-time highs, and if that changes dramatically, silver could face selling pressure that has nothing to do with its own fundamentals. Third, the strong dollar scenario. If inflation proves stickier than expected, and the Fed has to maintain higher rates for longer or even hike again, the dollar could strengthen further, which puts downward pressure on metals. Fourth, there is the possibility that this bounce is purely technical. A dead cat bounced to the 50% retracement level before another leg down. The $32 area is a logical resistance zone, and if silver fails to break above $33.50 convincingly, the bears have a case that we retest the lows. I am giving you this bearish case because you deserve to hear it. I am not here to sell you hopium. I am here to give you the full picture, but here is the bullish case and why I believe the weight of evidence tilts heavily in this direction. The structural deficit is not going away. Mine supply is flat to declining. Major silver miners are not investing in new projects because the cost of capital is high and permitting takes years. Mexico, the world's largest silver-producing nation, has tightened mining regulations. Peru, the second largest, has faced social unrest near mining operations. Supply is constrained and getting worse. On the demand side, the numbers are staggering. Solar panel installations are growing at over 30% annually globally. Each gigawatt of solar capacity requires approximately 280,000 ounces of silver. China alone is installing over 300 gigawatts per year. Do the math. That is over 84 million ounces just for Chinese solar. India is ramping. Europe is ramping. The United States, despite political back and forth, is seeing massive solar buildouts driven by state-level mandates and corporate commitments. Electric vehicles use roughly 1 to 2 ounces of silver per vehicle for electrical contacts and connections. With global EV sales approaching 20 million units per year, that is another 20 to 40 million ounces of demand. Artificial intelligence data centers require massive amounts of silver for conductors, thermal paste components, and circuit boards. The AI build-out is the most silver-intensive technological expansion since the rollout of photography in the 20th century. Defense applications are growing. Missiles, radar systems, satellite components all require silver. And central banks, while they primarily buy gold, are signaling through organizations like the BRICS alliance that the dollar-based financial system is being actively diversified away from. That is structurally bullish for all hard assets. J.P. Morgan, the same bank that was fined $920 million for manipulation, has reportedly accumulated one of the largest physical silver hoards in history, estimated at between 600 million and over 1 billion ounces over the past decade. Let that sink in. They suppress the paper price while accumulating physical metal. When they decide to let the price run, they will profit on both sides. As I said in the previous video, you are not trading against the market. You are trading against entities with unlimited capital, inside information, and a proven track record of manipulation. The only defense a retail investor has is physical metal, held outside the banking system, purchased at prices you are comfortable holding through volatility. 3 key takeaways, and we are out. 1. The 15% bounce off the lows is significant but not yet confirmed as a trend reversal. We need to see silver close above $33.50 and hold it to break the bearish structure. Below $31 and the bears regain control. Watch those levels carefully. 2. The physical market is telling a completely different story than the paper price. COMEX deliveries increased during the sell-off, Shanghai premiums widened, dealer premiums remained elevated, and industrial demand continues to grow at a pace that mine supply cannot match. A 4-year structural deficit of over 200 million ounces per year does not resolve itself with a 15% price drop. It resolves itself with significantly higher prices. 3. The concentrated short positions held by a handful of banks remain the single most important variable in the silver market. These positions are documented in the bank participation reports and the COT data. Until these shorts are covered, the paper market will continue to experience violent dislocations from physical reality, but shorts must eventually be covered or delivered against. And when the music stops, there will not be enough chairs. The unresolved tension is this. If silver truly is in a structural deficit, if industrial demand is accelerating, if central banks are diversifying away from dollars, and if the entities suppressing the price are simultaneously accumulating physical metal, then at what point does the paper market lose control of the pricing mechanism entirely? That is the question that keeps me up at night, and it should keep you thinking too. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Nothing I say here constitutes financial advice. I am sharing my analysis and my perspective based on publicly available data. Invest with logic, not hype. VIP out.